Well, as stated, my name is KRISTIN Parker. I'm the Director of Compliance here at RiskScout. Before my time here at RiskScout, which has been almost 2 years now, I was in banking my whole professional career as a little bit of everything, but mostly BSA compliance, BSA officer role for the majority of it. So I definitely know what it's like to be a banker sitting in the seat from the sales side to the compliance BSA side. And I'm excited to go through this information with you today because I hope you find it really valuable. And when you're evaluating fintechs and really understanding how they can fit into your institution to help streamline processes or make the customer experience better and so on. But Ryan, I'll let you introduce yourself.
All right. And my name is Ryan McInerney. I'm on the product strategy team here at RiskScout. My background is formerly with the OCC out of the Boston field office, and I did work in mid-sized community bank supervision as well as large bank supervision. When I was with the OCC, I specialized in commercial credit, BSA and compliance, as well as information technology. And as we're getting into the fintech piece a little bit here, one of the aspects of information technology from the regulatory perspective is third-party risk management. So it's something I've been fortunate and unfortunate to see a lot of. But looking forward to getting into a lot of the information we're going to discuss today.
All right. So we thought we'd start with the basics here. Really, what is a fintech to begin with? That word is thrown around so much these days, and so with the highest level, we can talk about fintech just basically being a technology that is used to improve the delivery of financial services. Really, one of the very first fintechs, if you really think about fintechs in that definition light, really dates back to 1866, I think it was, when the transatlantic cable and Fedwire were created, because that enabled money to move easier. So it's been around a long time, but really the popularity of it has obviously skyrocketed as technology has gotten better and that more individuals have been adapting to it. The projected value of the global fintech market by 2026 is approximately $324 billion. And in the US, there were about 9,000 fintech startups as of 2021. So that's an astonishing number. Think of, the amount of just varying fintechs there are too, which we will get into here shortly. But 9,000 is quite a bit, and it is, the steady growth of it year over year from just the early, to mid 2000s on up to now. We're now at this number, and it's probably as of this year significantly higher. Ryan, anything you want to add there?
No, I have some facts and figures of my own as we go farther in.
Okay. All right, so 9 out of 10 Americans now use some type of fintech app to manage their financial lives. This is from a report by Plaid, and they have surveyed a ton of people, and they are finding that out of the 9 out of 10, the fastest growing segment are baby boomers. And that meaning those age 56 and older are doubling year over year and adapting this technology. And I guess you could kind of say that's probably been forced and driven up maybe during the pandemic when, we were told if we left our house, we were likely going to get sick or get someone else sick. So we stayed home, and we're not going, and maybe our branches were closed if our branches are closed, or maybe it's because we have some younger generations that are already using it, and that's just the easiest way for maybe parents or grandparents to interact with their loved ones if they're sending them money or paying bills or so on and so forth there. Anything, Ryan, there?
Yeah, I think one thing to note there is when we think about the uptake and the use of tech, is over the pandemic, when you didn't have access to branches as much, you had more people downloading the apps that they'd be using for their banking provider. And a lot of those banking apps are going to have some sort of fintech embedded in it. So if you're using any of the major banks, you might see, oh, here's like your credit journey, or here's a way to maybe explore some different way of managing your money. Maybe you're getting advertisements for Truebill or something else, but there's just such a wide breadth of what's available in the fintech space that with the inability to leave your house, I think there was a lot of opportunity for people to start to explore those.
So again, we talked about the pandemic probably feeding into that adoptability of by people more and more, especially generation like the baby boomers. But interestingly enough, when this large group was surveyed, they said they flocked to it because it saved them time. We know that in this country, we're rushed around to do everything, and our plates are always way too full. And if you have the ability to avoid a stop at the bank or having to stop and email your banker to give them information they need, then why not do it? So 93% of them said it saved them time. 81% said it gave them more control over their finances, and 78% of them said it saved them money. And I agree wholeheartedly with all of that. You know, there's a lot of great apps out there that have the ability to, a lot of great fintechs to help you control your finances much differently than we used to, many years ago. And so many of these are being, like Ryan said, embedded into your just everyday financial life within your existing banking relationships. Banks are realizing and credit unions are realizing that more and more, and reports like this come out, that they have to provide a better customer experience, or there's plenty of other options for those individuals or businesses to go bank elsewhere.
Yeah, and one piece to add on that is we're looking at this from the consumer perspective, somebody that's coming to a financial institution and using the services of that financial institution. But when we look at these same items, time saving, financial savings, that sort of thing, financial institutions are getting the same benefit from different regulatory technology providers, or maybe different online banking or operational improvements that they might have with some sort of tech provider.
All right. And then consumer expectations, again, part of this report we've been talking about, being able to have a connection between their bank account and digital apps is really important to most people and most businesses. 80% of them said it's important that they're able to connect their bank account to the digital apps and services of their choosing. 76% said that connectivity was a top priority in choosing a bank. And 69% of them said they would consider switching banks if their financial institution couldn't connect them to a fintech app, which is really fascinating because from a community bank standpoint, the background I have is, working with smaller institutions and larger institutions. But smaller institutions, this wasn't a priority about 5 years ago, that connectability. And now we have this rush of people who, and whether it be brought on by the pandemic or not, of saying, I want to be able to connect these. This makes my life easier. So a lot of those community financial institutions are having to play catch up now and try to do it very rapidly so that they can keep up. Because with that kind of number saying it was a top priority, and more than half of people saying they'd switch their banks if that wasn't, it looks like we know what we should be focusing on, which is convenience and customer experience for the individuals and businesses that we're banking.
Yeah, when I'd say 3 to 5 years ago, when we were going at different community financial institutions, one of the biggest concerns we'd see is an aging customer base and ability to start to bring on maybe younger depositors or members. And when you're seeing even kind of the aging customers at this point starting to get into the fintech space, it really begs the question of, if you haven't invested in some sort of mobile app or accessibility from either a computer or your phone, you're probably going to start dropping a lot of the customers that you otherwise would have been able to retain.
Yep. All right, so when we talk fintech, we know we said it's very broad here, and this is a very good graphic for you guys to really realize there's different sectors here of the fintech ecosystem. Some fintechs maybe will straddle two different categories, but you've got them anywhere from alternative finance to banking software, RegTech, which is where RiskScout probably fits, or probably straddles a little bit. Ryan and I were kind of going back and forth, straddling between RegTech and digital banks software providers. But you've got all these guys out here that play a important part to the banking ecosystem in general now.
Okay, so looking at just general investment into the fintech space, if we go back to 2018, that was approximately $128 billion was invested in fintech, and that's versus total venture capital invested for that year of $254 billion. So when we're looking at the ability for these types of firms to innovate and kind of the almost blank checks that they had been given in the past just to figure out these different solutions, we can start to see why there are so many different fintech companies and why they can cover so many different items in such new and innovative ways. One example to think of is, I believe it's Tiger Fund is one of the main investors in the fintech space. And I had heard from multiple people that just the valuations and the amounts that were being given to a lot of these fintech companies were incredibly high. And with that, it gives them a lot of runway to start to figure out some of these new solutions that you can then use as a financial institution. The problem becomes, and I think one of the competitive issues is when you're looking at the resources of financial institution to innovate at this level is just not going to be the same. So being able to partner with some of these entities and work together is one way to get these new innovative technologies in and not have to foot the bill for that at the same time. So talking about, some opportunities, some challenges when we're looking in the fintech space, I'm just going to talk about a couple of examples. So when we're looking at market accessibility, that's not only an opportunity, but it's also a challenge when we're working with different fintechs. So the first example we can give is Nubank. So Nubank was what we would typically consider some sort of challenger bank. They began in Brazil in 2013, and they were focusing primarily on underserved populations. There was a really limited financial accessibility in Brazil, and it was kind of segmented to a couple major banks. Now, in 2021, when we look, 8 years in the future, Nubank is a publicly traded company. It has 41 million active users. So if we're looking at different fintechs that are targeting some of these underserved populations, that might be an opportunity for accessing a new market. It's new customers, and if they've worked hard on the onboarding experience or maybe some of the things that make it easier for a customer to get into your financial institution, we could be talking about a better customer experience. Same thing on the staffing needs. If there's been work there on the onboarding side and on the ongoing monitoring side, then maybe you don't need the same level of staff to manage those types of customers. Another example here would be Kabbage. So when we think about Kabbage, that was founded in 2008, and that was automated application processing for small businesses. So the bread and butter of a lot of community financial institutions that I had gone to was small business lending, small business kind of treasury management solutions, but being able to work with what's really the lifeblood of a lot of these communities is these small businesses. By 2018, Kabbage had funded over 100,000 new businesses, and that was over $4 billion in total funding provided. So we're talking about significant access to financial means for a lot of these small businesses, which is really important work, but just the scale of applications that's going out at the same time, that's not something that's going to be easily scalable on a human effort. You really need some of that automation and some of that fintech accessibility. So that's an opportunity to add more access to a new market. The problem becomes with both of these is the potential disintermediation of a traditional financial institution, where if Kabbage, Nubank have their own charters or something along those lines, then a lot of those customers may choose that speed versus going through to a financial institution on the back end. And when we talk about just values in general, which I'll get into another slide, I mean, Kabbage was acquired for $850 million by American Express. So there's a huge price tag being associated with these companies. And the last challenge I just want to kind of throw out there is something that we used to talk about on the regulatory side, is just understanding the black box that might be behind the scenes for some of these reg techs, financial technology, whatever the term we want to give it. The example that I'll provide is a fair lending one. So we had come across a scenario, I honestly can't remember where this was, but it's almost kind of like legend at this point. But the entity was using kind of this black box to determine whether or not they wanted to take on certain customers. And so the customers that were paying inside of a gas station were a worse credit risk than those that were paying at the pump. And we found out the reason being for that was because that they were mostly smokers and they were paying inside, so they could also purchase cigarettes, which reduced their disposable income. The problem that they could then have is maybe you have in certain areas where the gas stations might be located and the customers we're talking about, they could be predominantly from a certain income level. They could be predominantly from a certain race or other background that might be a prohibited factor for lending decisions. And if you don't understand that you're actually discriminating based on a prohibited factor, then you could expose yourself to some sort of liability. So just having an idea of what's going on in the back end is actually relatively important when engaging these firms. Okay, now going into the valuation side, I'm not going to go too in the weeds, but the reason we thought about this slide was I believe it was the FinTech conference, and there was a firm, and I can't remember the name of it, which honestly has really bothered me. But there was a firm that was talking about different price points for mergers and acquisitions when looking in the financial institution space. And so the national average for price to tangible book value on traditional banks and thrifts was about 155%. So if we're talking about actually purchasing a competitor, something like that, we're paying about 150% of assets, maybe something like that. And this individual that had been doing the presentation at FinTech was generally supportive of that, saying, you know, it could be 1 times, it could be 2 times, somewhere in that range. But when we started getting into some of these kind of quasi-tech, quasi-bank situations, that multiple would increase on the assets. So if we're looking at somebody that maybe had built some sort of application in their financial institution, maybe had created some new funnel of acquiring customers, their price to tangible book value might be 2 to 3 times, typically not going higher than 3 times, but maybe if they've done something very innovative, it could be over the 3 times ratio. Beside the point, the opportunity really there is if we're combining technology along with our underlying assets, we can increase the price to tangible book value on a financial institution. The Kabbage acquisition that we talked about in the prior slide, that was for $850 million. That was literally only the technology plans and staff. So the loan book was not part of that deal at all. And then we look at just a couple examples we put in the bottom left, the FinTech Innovation ETF. The price to earning ratio there is 43 times versus if we go to a community bank trust index, that's about 12 times. So you can see the disparity in how the market is treating FinTechs versus traditional financial institutions. Now, another opportunity we could think of is just diversifying your financial institution's value. If we're talking about those intangibles such as goodwill, maybe some of the technology we're building. On the opposite side, one of the challenges is that, you know, insane funding that's being provided to a space that's quasi-competitive with financial institutions, making it difficult to innovate a lot of this stuff on our own and really kind of forcing the traditional financial institution space to partner with a lot of these new firms.
So since we've talked about the desire for consumers to have easy access or to their funds or ways to move their money or ways to communicate with their financial institutions and what the value that can bring to institutions, how do we really know as a financial institution who we should be doing business with? Really, that's such a broad statement because what we're going to go through today is just really a guide for you being able to vet who you're working with. You know, really getting in there and understanding what your customers desire, or your financial institution customers desire is a whole nother webinar. It's a whole nother effort. At the end of the day, it's whatever your risk appetite is, it's whatever your institution is currently banking in their portfolio to say, what are my institution clients really seeking out here? And then from there, vetting them, vetting companies that can feed those needs really thoroughly so that you're understanding that who you're doing business with, because we're talking about some fintechs that are young, and that's okay if they have all their ducks in a row. A lot of cautionary tales are out there in regards to thinking you're going to be working with a fintech that has hung the moon, and you go and you find out that they're half delivering what they said they could, and their likelihood of survival is very slim, which throws your whole plan off track here. So in 2021, there were several regulatory agencies that came out with this guidance that touches on 6 topics on how to really do your due diligence on these fintech companies. So we're going to take a somewhat deep dive into each of the 6 categories here. First, the overview of the topics is business experience and qualifications. What's their financial condition? What's their understanding of legal and regulatory compliance and what those functions look like internally? Risk management and controls, information security and operational resilience. So we'll start with business experience and qualifications. When you are dealing with a fintech that is going to be assisting you with your needs of your financial institution, it's important that they have the right people in place that can really guide their fintech efforts in a way that's going to benefit you, and understand that you've got to really dive into understanding the qualification and experience of the management team and directors. It's okay if there's people on staff that maybe are former shoe shiners or whatever, but are they the ones that are up there managing the team? What's their experience for being able to get in there and understand what your institution needs are and how they can help you get to your end goal of wanting to partner with them? You need to know their short and long-term strategic plans. That is, it's the pits when we hear a financial institution saying, I've signed up with this fintech who said that this was what they were going to do, and they told me the famous words of, that's on our roadmap. That is so overused and not followed through with sometimes. And they pivoted completely. They shifted their goals. So now we're in contract with this fintech that no longer is headed in the direction of what we thought they were going to be doing. And as a result, I can't fulfill the goals that my institution was trying to achieve. It's always, always, always a best practice to contact current and former clients for references. If you don't have a fintech that is willing to give you a reference, I have to say that's probably a red flag.
Yeah, I'd run.
Yeah, you want ones that people they don't have to be gushing references, but they have to say, yeah, these guys are doing what they say they're doing, and they are responsive, and they are, they know what they're talking about. And they've served my institution to help us do X, Y, Z. It's really important to get those references and make sure that you are really vetting them from that perspective. Review of public records and adverse media for red flags. That could include the business itself. If it's a younger business, younger fintech, maybe there won't be any really public records or time for adverse media to hit. Maybe you're going to do some review of their executive management team, just to say, was there any potential red flags that I should be aware of in regards to these individuals behind the fintech. And then summary of key individuals and subcontracts. Knowing who's going to be really working for them, who's their thought leaders, who's their, navigating their short and long term. Who will they be using for subcontract? Will they be using some of their core work? Is it subcontracted out? And determining off that answer, how far do you need to dig into that subcontracting? Is it viable? Is it going to stay? If it's a big core of what they're doing, how do they know and how are they secure in knowing that they are going to be available long term to help meet those short and long term strategic plans? Anything to add here, Ryan?
Definitely. I think those that first and that last point, what's the experience and qualifications of the management team, the directors, the people that are really driving this company. That's going to be, I think, one of the most important things about any fintech that you're starting to engage with. So for example, if we were to look at, say you're evaluating RiskScout. So there's KRISTIN, has a ton of experience in the banking side, working with, it was one of the first hemp programs in the US, having formerly been a BSA officer, and then myself formerly been on the regulation side. You know that there's some subject matter expertise in the area. Whether or not you had vetted us as being competent individuals yet or not, at least on paper, we look like it. But if you're going to somewhere and it's, maybe it's 5 tech folks that are trying to solve some problem for financial institutions, it would be really important to make sure that they've actually adequately identified what the problem is for a financial institution and that they're solving the right problem. Because they might show you some pretty pictures, they might say, look at what we can do, but if they don't understand some of the problems and the trials that a financial institution might be going through, it could only be, surface level pain relief. And then really once you get in there, it's not something that's really adding that much value to you or your team. I've seen that firsthand, so I just want to warn against that. Okay, so looking at the financial condition, I think a lot of the stuff that we're talking about in this newly released guidance, and so this is, I believe it's news release 2021-8485 from the OCC, and you can probably find it on maybe the FDIC or Fed sites as well. But a lot of the information here draws on existing guidance, which was OCC Bulletin 2013-29, which was the third-party risk management guidance. And there's also FAQs that have been published on that third-party risk management guidance. So if you're looking for more, those are some places you can go. One of the important things there for just evaluating any third party in general is their financial condition. That's going to be critical to whether or not they're a viable company. If you sign a 3-year contract, but they go bankrupt in 1 year and you were relying on them for a certain service, that can put you in a dangerous spot. In terms of actually performing that financial evaluation, some of the key sources, looking at financial statements, any sort of public filings that you can possibly get. Maybe you've negotiated access to certain information on an ongoing basis from that fintech, just so you can verify that they are operating in a way that makes you comfortable that they're going to remain viable. And in terms of actually performing the analysis, you have individuals in-house who are qualified to do this. So one of the recommendations we'd usually have on a third-party risk management program is maybe pull somebody from the credit side and have them do the evaluation of some of these more complex third parties, financial technology companies. Some of your credit folks are well-versed in performing this sort of business analysis. So if you want to get a good review, just look no further than some of the people you already have on staff.
Legal and regulatory compliance. This kind of touches a little bit back on the first slide I went over, but researching a third party's experience working within the legal and regulatory framework in which your community financial institution operates is a good indicator of how a fintech will comply with applicable laws and regulations. They need to know what the regulatory framework looks like in whatever footprint you're in it, and what services they're offering. Some of the potential sources of information for that could be charters, could be lawsuits and complaints, could be probably not for younger fintechs, 10K and 10Q filings when applicable. It's really a big red flag when you have younger or existing fintechs that really don't know the importance of drilling down to the location in which that maybe that community financial institution is banking as well. For example, here at RiskScout, we know that we serve a lot of institutions who serve their more burdensome, higher risk clients, whether they're existing ones or they're onboarding new ones. And those institutions are throughout the US. The rules for operating certain types of businesses in these footprints is not the same. It's not a big blanket statement saying we can treat all of these businesses the same, no matter where they are. All these institutions, we can blanket statement a program for them. That's not the case. Stuff has to be customized to understand where their footprint is, to understand what it takes to bank these certain clienteles. And that's going a little bit deeper in than what at surface level this slide is about, but it's important to really think about who you're working with from that perspective, to know that they've got to have the legal and regulatory framework in place that is specific to whatever services they're helping you offer.
Yeah, and I mean, I think as we get further on the legal side of things and we get into the information security side, that's going to be something that we're thinking about as well, is how are they handling customer information if they have any access to it. And one thing that we see a lot of financial institutions or different types of companies that are doing their due diligence on us, they might ask, hey, do you have any customer references that use our same prudential regulator? Because if you're able to find someone that has a similar regulator to you, then you can get a better idea of what challenges there might be with doing business with that type of fintech, regtech, whatever the entity is. And now, moving on to the risk management and control side of things. Not all fintechs, I think, is an understatement. A lot of tech companies, fintechs, aren't going to have the best audit risk compliant functions, particularly to the scale that a financial institution might have. So when we're looking at some of the third-party reviews that have been performed on those entities, or maybe some of the due diligence that you're performing yourself, making sure that they have some, relatively well-defined lines of defense, making sure that they are reviewing and going through a lot of the information that they're using, and that there's a proper level of data quality on the back end of things. I think a nightmare would be having somebody do all this work for you and then finding out that that work was unreliable and potentially exposing you at the end of the day, not that fintech, to regulatory scrutiny. Now, when we're thinking about how that due diligence, how that evaluation might actually manifest in real life, requesting periodic on-site visits might be one way to do that, depending on what the entity might be. For example, with your core provider, I know a lot of financial institutions that will do that periodic on-site review with the core provider. So like, okay, what's the failover for our databases? What's the failover for different information? Where is our information stored? What location? That sort of thing. Another important thing to do just on this evaluation of risk management controls, and again, this is pretty well detailed in that 2013-29 guidance as well as this newer release, is the implementation of different service level agreements within your contract that give you the right to audit, that give you the right to conduct these on-site visits, and also require that partner you'd be using to remediate issues as they're identified. One problem that I've heard in the past, particularly from maybe smaller financial institutions, community financial institutions, would be that they don't have the kind of swinging power to negotiate those different service level agreements. And one solution we've seen for that is kind of this collective negotiation where you have multiple community financial institutions coming together that use the same maybe core provider and saying, as a group, this is something that we need in our contracts. Otherwise, we can't support this relationship. I mean, saying we can't support the relationship might be a tad aggressive, but coming together as a group to use that kind of joint negotiating power can be more effective in trying to get some of those service level agreements in there.
Ryan, a question for you I would have is, what about, again, we get a lot of, well, what if it's a bank sponsored fintech? What's my responsibility and what's their responsibility? So the fintech is sitting in front of the financial institution, but this financial institution is really responsible for settlements and whatever. Can you kind of clarify who's responsible for the legal and regulatory framework in regards to, from an examination standpoint?
Yeah, I mean, when we were going in as regulators doing the IT third-party risk examination, or I guess part of the examination, really all of the responsibility is going to fall on the financial institution. The fintech or any third party is an extension of the financial institution's responsibilities. And so the real imperative piece for an FI is going to be, am I managing them to truly understand the risk and understand what's happening at that third party? Because if you're just farming out the entire thing and then you're not checking maybe periodic reporting or some sort of process that gives you an assurance of the quality of work that's being performed, then that's irresponsible, frankly, from a regulatory perspective, and we're worried about that. But if something does go wrong, the financial institution, the board of directors, the management team, they're going to be the ones left holding the bag.
Yeah, I had somebody I was speaking to at some point that ran a fintech that was sponsored by a bank for cannabis businesses, the THC cannabis. And after inquiring with her for a while and talking, I'm trying to better understand who's the sponsoring bank, and finally it's revealed it's Bank of America. And I'm like, do they know? Oh yeah, they know. And like, are you sure they know? Yeah, well, my personal banker knows. Like, so there's a real risk there from a red flag perspective that your frontline staff, really, there's some education that's needed there on who they're, your account opening officers. What are the real questions being asked to uncover what these businesses really do? Because you may be banking fintechs already and you just don't know it. So that's just some food for thought from a cautionary tale that it's 99.9% as somebody who's worked at Bank of America knows that they would not willingly bank that. So just keep that in mind as you're thinking about your staffing and training from that perspective.
Yeah, and KRISTIN, what you bring up there reminds me of, if you just think about the COSO framework in general, the dissemination of what the financial institution's risk appetite and risk tolerance are should really be to all employees of the financial institution, so things like that do not happen.
Yeah. Ryan, you want to take this information security one?
I'd be happy to. Okay, so when we're thinking about information security, I mentioned a little bit on the prior slide of understanding how the fintech is managing the customer's financial information, if they have any personally identifiable information that needs to be really given a whole different level of security than maybe just like maybe just an API feed that's going into your financial institution. So when we think about personally identifiable information for your customers, is that Fintech SOC 2 certified? What are their processes in place for managing that customer information? If there is anything that's going to go wrong, so for example, if there is some sort of breach, maybe there's a permanent loss of customer information, anything like that, what's the process for notification to you as a financial institution? And what's the process on their end as well for maybe notifying that customer or engaging with your customers? Do they have the right to engage with your customers? Do you expect them to? Do you not expect them to? Making sure all of that is really flushed out ahead of time.
Yeah, I have been in some nightmare information security situations at institutions sometimes where there was a breach on the software provider's side, and really drilling down and understanding whose responsibility is what is really important. Uh, just echoing what Ryan has said there, because I have seen it mishandled at institutions poorly, and institutions taking on responsibilities that really that software provider is responsible for. And so just be mindful and very strategic about those conversations. Should anything happen, I would always recommend speaking with a legal counsel to see really where this responsibilities lie for those.
Yeah, and I mean, when we think about like the program that you'd have in place at your financial institution, there's penetration testing that's going on to making sure that nobody can get into your system. And then there's tests that are happening to ensure that if somebody does get into your system, that there's segmentation in place so they can't access the entire thing. You'd expect similar safeguards and testing at any fintech, regtech, whatever the partner is, to make sure that they're not your weak link.
And what really, I guess that would boil down to, that's happening on a reoccurring basis if they're SOC certified, right? That's
Yep,
part of it.
you bet.
All right. And then operational resilience. How is your fintech going to keep their business running? What's their continuity plans? What happens in a disaster? What happens if everybody there gets COVID? Like, what is really going to understand, what are they going to do to ensure that the business continues to operate on a continuous basis? Maybe you review their continuity plans, their disaster recovery plans, insurance documents. I don't know a lot of fintechs that would necessarily give those up, but I'm sure it's always worth the ask. And then take the time to really understand, again, back on the first slide in this, is what's their reliance on subcontractors? Is it majority of their staffing is subcontractors? What's that viability there? How are they monitoring their subcontractors? I know some institutions that say we do not allow at all if you use any foreign individuals, non-US citizens as a subcontractor, then they can't touch anything on our system. That's some stipulants that some of them have in there, right, wrong, or indifferent, it's based on their risk appetite. But just truly understanding and how they continue to operate should the worst happen in regards to any type of potential disaster for the business.
Yeah, and on the insurance side of things, some of the things you might be thinking of when you request that information from the tech partner could be, if they're not going to give you the entire policy, just information on those policies. So you might be asking, what's the total policy limit on, say, the general liability policy? What types of policies do they have in place? Is it general liability? Is there some sort of cybersecurity based policy, which personally, sometimes those can, I think those can kind of blend between your general policy and that cybersecurity one, where the two insurance companies then start fighting with each other. So making sure that those aren't conflictive is relatively important in that space. But then also figuring out, what's the minimum claim amount that somebody could even put in on these? And is this supportive of the financial condition that you had evaluated before? Is there a certain amount you would have expected to see on the insurance side that would keep them, I guess, viable in the event of some sort of event? So before, KRISTIN had mentioned, we were kind of talking, where does RiskScout really sit? Are we on the RegTech side? Are we a online or the banking provider side of things? And so from that bore our slide on what do we actually do. And so RiskScout is a relationship management system at the end of the day for higher burden customers. And the relationship management is really for the customers as well as for the employees of the financial institution. So you can coordinate different business lines within your institution, say business development, compliance, risk, making sure everyone has a centralized place to go to manage these customer relationships and to communicate with that customer. Because as we know, trying to get things, say on the loan side, like loan review, trying to get maybe financial information or whatever it is from the customer can be a burdensome process. So we tried to simplify that with the way we communicate with customers to get that information into the system and then internally allow you to share notes or assignments with one another. So what is it for? It's for improving your customer's experience. It's improving your employees' experience, expanding the markets which you can serve, and also providing technical expertise and guidance on areas that you might not be as well versed in. And that comes from myself and KRISTIN. We're always happy to help the individuals that are using our system, using the partners that we have. What it's not for one business line. As I mentioned, we're connecting the different business lines that we have at the financial institution. It is not for being stuck without support where you're just given a software system and everyone walks away. We offer our expertise and help throughout the partnership. And it's not for past due purgatory. I can say more than one time I've gone into a financial institution and there is maybe 15, 20% of reviews are overdue or something like that. We're trying to organize all the responsibilities that the financial institution staff have in one place so that things are well organized, that they're being completed in a timely fashion and being completed in an easier way.
All right, so just one little last RiskScout slide for you guys. We really are proud of our software. It's built by bankers for bankers, and really the things that used to keep me up at night as a BSA officer and keep my treasury management people up and whatnot, we were able to get in here and solve for and streamline for institutions. So should you want more information, you're happy to pick our brains about it, then let us know.